So one solution, of course, would be this thing that people know from TradFi, delivery versus payment. There are versions of that out there, not all kind of the same flavor. Some people tend to do it a little bit differently. Would that alleviate this problem if it was done in a very simultaneous way?
I think it's a step towards, but let's do the process. Now, instead of the client saying, can you please buy $1 billion of Bitcoin? Deliver me the Bitcoin, then I will deliver you the dollars. What's happening is it's done atomically once both parties have posted their side. What it mitigates is credit, because nobody takes possessions of the asset, but it doesn't change the problem that I still have to lend my balance sheet for this trade to be processed, which is possible. It's not an issue to lend the balance sheet.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital asset industry. I'm your host, Ian Simpson, and if you want to know what banks, hedge funds, asset managers, and others are doing in crypto and how they're doing it, this is the place for you. My guest today is Thomas Restout, Group CEO of crypto market maker and OTC trading giant B2C2. He was previously Managing Director and Global Head of Macro Electronic Trading at Morgan Stanley. He also had a short stint at Goldman Sachs in FX electronic trading. Thomas, welcome to RULEMATCH Spot On.
Thanks, Ian, for the warm introduction. I'm delighted to be here. I hope we'll have an exciting conversation about the prospect of next year. And I wish RULEMATCH the best in that story.
So just thinking about crypto markets in general, I mean, the last few months has been actually pretty quiet, almost, could we say, boring. Volatility has kind of gone out of the crypto market, at least in the top coins. Is this lack of volatility making crypto better to trade, maybe more attractive for institutions, or kind of what's your take at this point?
I'm not sure I share the view that volatility dropped. I think we went through, we'll probably go back to October if we want to talk about the last couple of months. Of course, we had 1010, which now has a name, which was the beginning of a change in the ecosystem, certainly in mindset. We've seen the largest liquidation ever, and that was the trigger for what define the next couple of months. We've seen November, actually the entire October and a big part of November were fairly volatile because we've seen a retracement of 35% in major coins, more in some. So I think it would be unfair to say that it wasn't volatile. I think it was highly volatile. And then we went into December where the regime was a bit different because over the previous 2 months, we kind of attacked the open interest in futures as people either got liquidated or decided to exit the market as they thought it was not a regime they wanted to be a part of. And then when we went into December, we saw slightly different behavior, which was dominated by options. 26th of December was the largest expiry ever in the option market, and it is my view that the weeks prior were dominated by flows or gamma flow, delta that was being traded by option traders that was dominating the market, and we started seeing those Bart Simpson type of patterns. But when you look at volatility, implied volatility was still trading fairly high, and realized volatility was slowly coming down with two factors: less participants. I think after the mindset of the crypto participants going into December was not uplifting, shall we say. Options were the last one, and we got to the end of the year where I think it was necessary for the market to reset.
And institutions in this environment, how are they looking at this at the moment?
I think they have the side. If you look at what if we use, for example, ETF as a proxy for institution, if you look at what they've done over the course of December, we talked a lot about inflows and outflows of ETF, but if you look at the notional amount of outflows, even if you make it $5 billion, it doesn't really matter. I think it was 3 something. It's still fairly small, in percentage term versus the asset under management in each of those ETF. What is for sure is the value of the ETF collapsed 35%. If you take Bitcoin ETF, that's because of price action, not because of outflow. So I think the benefit of institutions coming in and buying those products is they're far more resilient. They will sit on their views and positions for longer. So, as much as we can't say that there were inflows in the last 3 months of the year, I think it will also be unfair to say there's been an exodus from institutions. That's for the trading part. And for the building part, as we've seen for a long time now, institutions continue building regardless of the environment. My personal view is that unless there is a shift in the regulatory trajectory, there will not be a shift in institutional adoption. They look much further than a month or two. I think people remember, you talk about changing volatility in regime, but we're pretty fast to forget that on the 9th of October, on the 6th, I think was the exact day, Bitcoin was trading at its highest value ever. I am pretty sure at this point, if you had asked pretty much anybody, they would have been maybe overly optimistic about the outcome of the market. So the shift in mindset in the last 3 months is probably the piece that has changed the most.
And as far as shift and changes in the market and the participants, you would say in the last 6 months there hasn't been that much, or has there been a shift and change in what people are doing and how they're acting in the market?
You have, I think, adoption continues materially through the extension of all the wrappers. Last year, let's say the year before was the beginning of the ETF. Last year was material adoption, expansion of the number of ETF, but also DATs who have, I believe, a cumulative treasury of about 150 billion, which is more or less on par with the ETF. So, everybody's entitled to an opinion on DATs, but what they are for sure is a regulated instrument that institutional players know how to acquire in a regulatory framework that they understand and that they are confident in, and a settlement or operational process that they are familiar with. So we really had a lot of ETF, a lot of DATs. So it allowed a lot of institutional participants to come in. And then we're expecting the next wave of them to come. And probably those ones will be the ones that actually trade the underlier. Because what we've seen is people trading securitized versions of tokens, not adopting wallet infrastructure, blockchain, and the operational framework that goes around. And my view and my belief is over the next, probably it's a slower development that people want, but what we are seeing people work on is actually buying, selling, operating on the blockchain itself, using wallet solutions. And I think that will be the next level of transformation.
Actually doing crypto instead of just playing in the securitized ETFs, Correct. So on and so forth. So B2C2 does a lot of OTC trading. That's one of the main things that you do. Of course, it's not surprising maybe that institutions would look to OTC trading for large trades. Is that perhaps also because on retail exchanges, CLOB exchanges, market makers are less reliable, liquidity is less reliable. How do you think about institutions as they're now maybe going to start coming in and trading the underlying, what they're looking at and what they would be looking for in a market structure so that they can participate in the market?
Exchange and OTC providers or bilateral transactions have always sat side by side. My background is fixed income over equities, which is traded far more on exchange. But in the fixed income space, you have most of the transactions actually happen bilaterally. And why is that? Because if you go on an exchange, you will have a more deterministic outcome, but a more rigid product. You can buy and sell under conditions that are the same for everybody. Whereas as soon as you come to the OTC space, you will get a service on top of a product. So you will have the ability to discuss your financing, your legal agreements, your settlement cycles. Everything can be adapted to the needs of the given client. And on top of that, to the point on liquidity, a large part of our job is to have access to a huge amount of liquidity. We're not bound to a given exchange. So if there is an exchange that is either low on liquidity or even doesn't trade on par with the others because of inventory reasons or any other reasons, it is our job to make those adjustments and to provide the service to the client. And that's for all that I have described is within mine, spot in particular, and probably options or listed options would be the alternative or the comparable in what I just described. But on top of that, we offer the whole host of financial services. So it's not just, I would like to come and buy a Bitcoin. It's, I have Bitcoin that I would like to keep because I believe this Bitcoin will go higher. Therefore, in the meantime, what should I do with my Bitcoin? I'd like you to offer me treasury solutions, for example.
Mm-hmm. So the preference for OTC trading is not just because of ticket size, but also because of the services. Is it also because of privacy, risk mitigation, some of those other things as well?
You have privacy, of course, because the orders are not visible to anyone where we manage it. We actually take the risk, so you can actually be executed before we go to the market, which enhances privacy. But while it matters to a small number of people because they execute very large clips, I would still say that most in volumes, for sure, most of the volume that we process, this is not the number one priority. The number one priority will be reliable price, deterministic execution, fast settlement cycles. This is what clients are looking for.
And since you've been in the space and even coming from TradFi into the crypto space and over the last couple of years, how has OTC trading changed, kind of the what people are looking for, what you are able to offer, what is competitive versus other kinds of trading and so forth?
Ironically, I don't think it's defined by the clients themselves. I think it's defined by the level of competition. It's always a reference to something. And I think the over the last couple of years, we've seen our own capabilities improve materially. That's what we do continuously, but we've seen our peers progress. We've seen the number of our peers progress. So the standards are becoming more and more competitive, meaning clients are more demanding. They want even faster settlement. They want tighter prices in bigger sizes. And that's a natural development of the market. And I expect that competition will carry on and continue to increase the service that clients receive from firms like us.
And as far as price discovery and spreads in a market that has a lot of OTC trading, is that competitive? Will that continue to be competitive? Are people happy with where they are, or are there moments like the 10th of October when perhaps, obviously spreads can get a little bit out of whack there?
I think it comes back to, so of course I haven't compared B2C2 service during an event like 1010 to all the benchmarks possible. All right. But what I can say, when it comes to service, for example, we had no liquidation on 1010. Post 1010, it was all about liquidations and ADLs and all those stories that came out. On our client base, no liquidation. Why? Because this is our job to manage credit counterparty. It is our job to manage this risk. And we have, we don't service 200 million users. We service 1,000 institutions. So our ability to understand our clients is far superior to what an exchange can provide. It doesn't make us better or worse. It makes us different. And then in terms of pricing, it's so hard to define quality pricing during an event like this when you had up to 5 or 10% basis between two exchanges. If you have zero spread on two exchanges, but 10% basis on both between the two, obviously is one's a terrible price, one's an amazing price, depending on your direction. But it's not even defined by the bid offer. So it's hard to define what was a good price at the time. What was important for us is be there, help our client manage the risk, avoid liquidation, and provide them what we believe was a fair and good price for them to manage their risk. Mm-hmm. I would say on the other side of an event like this, our clients are still healthy. We are very healthy. I think mission achieved.
Mm-hmm. And as far as the market in general goes, how would market participants better prepare for events like that, or what could develop and grow and maybe change as these institutions come and look to trade the underlying?
It depends who you are, but I like those examples of post 1010. The whole spark reflection. Why? Because the whole paradigm of crypto and blockchain is the ability to process orders of magnitude more transaction, the ability to move capital or any type of value on chain much faster than what the current financial industry can do. And then you're like, okay, well, this is wonderful, and it could provide benefits such as I will allow you, if you would like to trade derivatives, to get more leverage than you would get in traditional finance, because it'll be faster for you as a user to top up your margin, for example, and it will be faster for me to execute and get my money back. And then you think about it and you try to translate that into the traditional finance, and how much of a benefit is it really to only have, well, actually, it's not even to only have 5 minutes to top up, because you are continuously liquidated in the crypto space. So as soon as you trigger your margin, you get liquidated. There's no time for you to post margin. But that means that if you're a traditional player and you don't operate over the weekend, you hold sizable positions, you cannot reasonably work with a partner that's going to tell you, well, on Monday, sorry, you got liquidated, it just touched your level and we make the decision. You were automatically liquidated. So we have processes, ability to provide our clients with windows for settlement. They can be longer, they can be shorter, depending on their needs and their capabilities. But I think if you really wanted to bring, if you're a traditional player and you look at the space and you decide, I don't know, I want to put on a basis trade for $3 billion, which is a big size for crypto participants. But if you look at large traditional players that we're expecting to come in, it's actually not particularly a particularly big size. You cannot be auto-liquidated on a blip of the market. It's not reasonable. Your risk officer should not and probably will not let you do that. And if you look at where most players have been putting on the basis trades, for example, it would be on the CME. most will say it's because it's the only place they have access. I would argue it's also because the mechanics of how margin calls are done is well known, understood, and of sufficient time for those participants to post capital if need be. Mm-hmm. So I do, if I have to sum up, I think the benefits that we've created within the crypto space or the blockchain ecosystem sometimes are not benefits for the traditional players who are not ready for it.
So there'll be a time of transition and figuring things out and so on. And when we think just of OTC trading and these institutions maybe that come to B2C2 and consider doing business like this, or even maybe smaller players, the bigger players, we'll get to that maybe in a minute. What are the risks they're looking at? How are they evaluating the risks, especially when trading OTC or trading this underlying maybe that they haven't felt comfortable trading up until now?
They look, well, there's a whole range of risk, and they will always start by the first one. Where's my money? Who's my counterparty? And therefore the credit exposure that they have to it. Then you get into legal agreement for which I think the ecosystem has done a good job at adopting standards like ISDA to trade derivatives. Of course, the terms dictate how we operate, but therefore what type of risk they carry. And these are all the risks that they are used to and familiar. Then they have to get used to the fact that it's an asset that trades 24 hours a day. Also, that's an asset that has particularly high volatility. And as we've seen on the 10th of October, liquidity gaps or air gaps that can generate very steep moves. And they have to apprehend that. Usually, I tend to think that the hardest job is for the risk officers who actually have to deal with new risk that they are not familiar with. Mm-hmm. And then you'll have the entire layer, which is, I said, depending on whether they use derivatives or securitized version of the product, but we'll say derivatives by opposition to trading the actual underlier, because if they trade the underlier, now yet again you have a whole new host of risk. What's a wallet? How do I operate it? Mm-hmm. Do I need a custodian? What is this new envelope of risk? How do I actually measure it? And even conversations that don't exist. You have stable coins on your wallet. What type of risk should I assign?
Totally new concept.
It's a new type of risk. So you have the traditional ones, which needs to be twisted or adapted to the crypto space. You have the specific one relative to market infrastructure, and you have a whole host of layers where people start to engage into trading the underlier themselves.
Mm-hmm. And of course, one risk in that whole list of different things to look at is settlement risk. I suppose most smaller players, if they were trading OTC with B2C2 or other OTC desks, would settle first, and then the other side settles back. Now, big players come into the space and probably won't accept that kind of arrangement. So how would that perhaps change things up in the space?
I think what it'll change mostly is the usage of balance sheet, and therefore the cost of actually executing. If I simplify the problem, I would love to buy $1 billion worth of Bitcoin. Wonderful. Send me your $1 billion. I shall then buy the Bitcoin and deliver them to you. Okay, that was the old, that's the current paradigm. And now what's going to happen is, I would like to buy $1 billion worth of Bitcoin. First, deliver me the Bitcoin, then I will give you the dollars. All right, so the first thing I need to be able to process that order or make a price, I need $1 billion in my pocket right now to buy the $1 billion worth of Bitcoin. So, of course, from a balance sheet perspective, it's a vastly different conversation. So there's credit on one side, but there's also balance sheet on the other. And when we talk about balance sheet of the ecosystem, they have grown quite substantially over the last couple of years, but they're still fairly small versus what we find in the TradFi space. So
is that a hindrance maybe to some institutions doing business in?
I think so.
Yeah.
I think so. But even if you, if I had to be a bit cynical about 10-10 again, and I see the fact that there were not that much outflows in ETF, in DATs, or others, okay, that's one positive aspect. But if I was sitting on a large position, I would probably be asking myself, how much would the market really move if I had to liquidate a very sizable position? Not 100 million, like a very sizable position. And I do think this is something that's hard to evaluate today and adds to the list of risks that you were asking me about. And comes back to balance sheet, by the way, because if suddenly you will require a settlement before, the first thing you need to do, if you want to liquidate $1 billion, is find somebody that has $1 billion. That's the first thing you need to do. And then you need to trust that they're going to give you a good price and be able to actually do the trade and settle. But the proposition is a bit different than if you are fine to deposit dollars first and then execute.
So one solution, of course, would be this thing that people know from TradFi, delivery versus payment. There are versions of that out there, not all kind of the same flavor. Some people tend to do it a little bit differently. Would that alleviate this problem if it was done in a very simultaneous way?
I think it's a step towards, but let's do the process. Now, instead of the client saying, can you please buy $1 billion of Bitcoin, deliver me the Bitcoin, then I will deliver you the dollars. What's happening is it's done atomically once both parties have posted their side. What it mitigates is credit, because nobody takes possessions of the asset, but it doesn't change the problem that I still have to lend my balance sheet for this trade to be processed, which is possible. It's not an issue to lend the balance sheet. It just means until I can process Let's Trade during a day. If I only do $1 billion trade and I have $1 billion balance sheet, then I can only do one at a time. So it will slow down. It will increase the price, basically. We'll say, okay, well, I'll do your trade, but because I'll be starved at balance sheet for X amount of time, there will be a cost to that transaction, which is superior to you deposit the dollars and I deliver the Bitcoin later.
And so how does the market transition or move through this kind of period?
I think we'll see innovations. We see a number of solutions coming in, whether it would be within the custodian infrastructure, whether it would be solutions who are multi-custodian and lock in the assets. So we already, I think the ecosystem or participants have made progress in solving the credit side. What they haven't yet solved is the balance sheet side, because maybe we will find a solution that says, okay, I would like to buy $1 billion of Bitcoin. I've put my dollars at custodian XYZ. By the way, you can now use this $1 billion to trade on exchange, and then you'll bring me back the Bitcoin. With all the solutions that have come where capital is deposited in a facility that then mirrors on exchange, you can have the combination of both. I have not yet seen it, but you can have a combination of both, where the client doesn't have to put its capital at risk. The market maker will not have to put its balance sheet at use, and there is no credit risk because it's atomic settlement.
So that would be a great development. Some kind of in-between solutions have been these tri-party settlement, off-exchange settlement facilities. There's many different flavors, many different versions. Is that something that you engage with and use, and is it going to continue in that way, or is that only kind of a transitional solution?
To the extent that we can solve the balance sheet problem, I think it's amazing. You have a material mitigant to credit risk, and you have a solution that is balance sheet efficient. I don't see why we would revert from that. If you take it to the TradFi space, what the TradFi space has done is they're taking orders of magnitude more credit risk, and they do a T+2 settlement cycle, sometimes with facilities to net or to clear the flows. So they have managed to take to do I would say a better job of managing a balance sheet by extending large lines of credit, but they still have lines of credit, and I think we can do better today within the blockchain ecosystem, that we can do both, solve for the credit side and the balance sheet side at the same time.
One solution to this might be more prime brokerage from people with bigger balance sheets. Think really tier one banks from Wall Street, names like JP Morgan. We had somebody on the podcast last year who was dreaming out loud and said his holy grail would be if JP Morgan opened a crypto prime brokerage. Probably not going to happen tomorrow, but that would be one solution, right?
It would be a solution, but why would it be superior? Because in this case, you have what you're doing is if you use a prime broker, you are concentrating the credit risk on that prime broker, whose unique job is to manage that and balance sheet. All right, you're still relying on a third party to have done a good job in managing their credit exposure and their balance sheet. Of course, if it's a tier one name, like you mentioned, the trust in these institutions' ability to do that has been proven, and it works. But the solutions we're trying to design, they would allow you to bypass the need for a prime broker. If you had your $1 billion, whatever, let's say it's in stablecoin to keep things easier, it's with your custodian, and every relationship with your market maker and the usage the market maker can do of that money is orchestrated, organized by the smart contract. You don't need the prime broker layer. I have my $1 billion right here. You can go on exchange A, B, C, RULEMATCH, and I will be the credit counterparty. But it's not you're not relying on financials or anything. That money exists. It's right here. It's being distributed. There is no credit risk.
Mm-hmm. And how close are we to solutions like that? And how
technically we're getting a lot closer. I said you have solutions now that are multi-custodian. They will see where your assets are in different custodians and have the ability to lock them for usage. So the technical solutions, I think they are getting closer, but then you need a technical solution and an adoption. So you would need the exchange to accept that solutions. You would need the clients to accept that solution. So there is a journey to get there. But ultimately, I don't know if it's better than a prime broker, but it's a solution that does not involve relying on the credit of a counterparty.
And obviously relying on one party to hold assets and to manage everything for you. That's FTX a little bit in a different way. I mean, different flavor in one sense, right? And so, of course, what we built at RULEMATCH also tries to avoid that clump risk and counterparty risk that's been inherent in the space up until now. Going back to adoption and the name we mentioned earlier, JP Morgan announced that they were now looking at actually trading crypto and allowing their clients to trade crypto. If you were sitting somewhere in a boardroom in New York City advising Jamie Dimon how he might go about that and setting things up to run an operation of trading crypto, do you have a list of things that he might need to consider or recommendations or ideas for him?
If I had to choose, I would rather advise Morgan Stanley, not because they're a better bank, but this is the last place I worked before.
Same Morgan Stanley then.
So I've done my best effort to advise them in the time on how to do it. I think it starts from who. It's always a question for whom. Mm-hmm. Who are you targeting? And if you take firms like JP Morgan or Morgan Stanley who have extensive prime brokerage business, they have already offered their clients access to exposure. If you prime at those banks, you can trade the ETF and you can trade the CME future. So do they already give you access? Yes, they do. But let's say tomorrow they decide that they will allow you to buy and hold a Bitcoin. Who is that for? And I think that's a big question, because before you define the wrapper, you want to ask yourself, who is that for? And am I trying to build an infrastructure that allows my clients to take exposure, at which point you see a Morgan Stanley say, I'll just issue my own ETF and allow my client to subscribe to it. And then you will have other solutions that have been considered. We've seen NDF, we've seen TRS, which are, NDF is the fixed income version, or the FX version, and then TRS will be the equity one, which are synthetic exposure to the underlier. Am I addressing a hedge fund that's looking to get exposure, an asset manager that's looking to get exposure? Or do I need to provide physical access because I'm addressing clients who want to hold the asset? And it can be an ETF itself that actually needs to buy the physical. So there's a big question, as when you're a very large bank like this, you can either go the product road and say, well, I'm going to do a product and I'll figure out who wants my product after, or I can decide who I'm willing to service, considering the size of those company, and therefore have a much better understanding of the product that you have. But if you take the physical, you either become yourself some sort of a custodian and you manage the entire life cycle of the product for your client. The client never takes the Bitcoin away. Or if you want to allow the client to withdraw the Bitcoin, then themselves, they need to be capable of doing that. So if I had to think how I would order it, I would first do securitized product, then do derivative solution. Some other US banks, where I actually worked as well, is already offering derivatives solution, and I would be walking towards a physical solution.
But you're kind of in the last step in that.
In the last step,
yeah.
I think
it's always a matter of risk and resources and
capabilities. I think for I don't know if the comparison is as relevant as I want it to be. But let's say you're trading commodities and you're trading oil. The first thing you're going to offer as a product, if you're a financial institution, is probably not delivering an oil barrel to your client. You're probably going to start by financial exposure to the asset, derivatives exposure, hedging, so on and so forth, and eventually get to physical trading, but not the other way around. And I don't think banks would go any different. Now I'll offer a slight twist to that, which is the custody part. So if it's not for the purpose of trading uniquely, there's an immense dimension of custody. Because if you do want your client to be able to buy a Bitcoin and take it away, you probably want to offer the custodian services that goes with it. That's one piece. And the second piece is, if you believe in the tokenization of real-world assets, in particular financial assets, and even if your belief is not that big, you probably want to ensure that should it happen, you can custody the assets of your client, in particular if you're large custodian banks. So I do think that there is, what's the journey of offering financial exposure? There's also offering the services that allows for the custody of the assets, and then all the other solutions. But these are probably the main two.
So it's fair to say then that if people do believe in a tokenized future, they're better off to at least understand and get themselves ready for physical crypto assets in certain technical ways so that they would be ready for what comes next. JP Morgan also has its deposit token and its tokenized platform Connexus and so on. You at B2C2 were involved in the deposit token transaction that they launched. We've had JP Morgan also on the podcast to discuss some of that. I wonder if in some ways big banks like them with this deposit token and different kind of rails, is there a case to be made that the banks maybe don't want to offer all of the financial services but to own kind of the post-trade money flows, payments and so on in a crypto tokenized world? Is that kind of how you see it as well?
Well, I think there's a million reasons why they should, full stop. I'll pick a few. It's their choices. I said there's an identity conversation. There's a capability conversation and there's an identity conversation. The capability, I think, is a key one, especially if you think there are multiple reasons why on-chain movement of value could happen. I don't know, it can be payment and stable coins. JP Morgan is probably a top 3 payment processor on the planet. It can be a solution to move value for prime brokerage. If you want to make margin calls that are much shorter and allow your users to be more capital efficient with the same leverage or give them more leverage for the same amount of capital, making you better than your competition. And by the way, it's not in a vacuum. That's another utility for a stablecoin or a tokenized deposit. If you think that equities are going to go fully on-chain, you definitely want the core capability to be able to respond to multiple use cases. And do I think the JP Morgan tokenized deposit will have some leg? Probably, and it did in a different way than Circle or Tether, Ripple, USDG, you name it. I think they will have a different utility to the system, and they will need to cater for the JP Morgan client base. But all those use cases, whether it comes to payments, maybe, but they will need a lot of adoption of their tokenized deposit. Can client use it within Connexus to move money in the JP Morgan ecosystem? Yeah. Can it be powerful if it's linked to the prime brokerage offering? I think it can be very powerful for a bank like JP Morgan, but slightly different usage to what we're used to when moving tokenized versions of dollars.
And so your participation in that is that a little bit B2C to look into the future and thinking about the next steps, whether it's stable coins, deposit tokens, tokenized assets. How are you thinking about things at this stage and going forward?
Yeah, of course. Well, for us, there's JP Morgan is a key partner, a sizable one. For us, a very capable one, and imagining that they will have a say in the story, whether now in the future, is probably a fairly safe
bet
assessment. We'll say that. The second thing is when we see how the story is evolving, and now that we're talking about tokenization of assets, and there's a lot of chatter about, is this the time where we make a difference in the actual financial system? Who better place than the largest bank of the planet, probably the largest financial participant of the planet, to partner with on the journey of changing financial pipelines. Pipes, not pipelines.
Yeah.
So for us, it's a key partner in that journey. How fast it's going to go, I think you have to look at the other side, which is more to the native exchange, what they are doing, how they've pushed the latest announcement from the largest U.S. exchange, and the aspiration to become exchange everything. You can see a world that has entirely been built on blockchain with clients who are uniquely, well, not uniquely, but has a very good understanding of the assets that trade on blockchain, wallets, how it operates, layer ones, and getting into DeFi, and they're now being offered a whole host of new products. And on the other side, you have firms like JP Morgan's who are already orders of magnitude bigger, who will be orders of magnitude slower, but will try to leverage the same paradigms and technology at those upcoming participants. Is there a race between Coinbase and JP Morgan? That's not what I would say. Do I think that the rate of growth of companies like Coinbase certainly creates the interest, probably not
questions,
probably not the fear, but certainly the interest and the questions. It's worth looking at. Yeah, I think so.
And when you think about tokenized assets, you mentioned tokenized treasuries has been a big thing, the money market funds, BENJI and BIDL and so on. What are you looking at? What are you keeping an eye on in that space for B2C2 in general?
It's an interesting one because I'll say tokenized money market funds, in my opinion, and certainly not technically, have not lived up to the expectations.
Can you be specific?
BIDL has been fairly successful, at least appears successful. We have BENJI on the other side, but what's the AUM of those money market funds, especially when you compare that to the AUM of traditional money market funds? We're at 0%. That's the actual number. And then, so that's on how much people are holding money in those money market funds. And then you have the second one, which is what's the rate of usage? Velocity, how many transactions, so on and so forth, which is fairly low, which means there's not a lot of money yet in those money market funds, and it's not used. People are eventually parking money, but they're not doing anything with it. And I do think part of the explanation is, first, a lot of those money market funds are still based on the traditional underlying money market funds with the same constraints, daily interest, so on and so forth. Some of them have made significant progress, like BENJI, that gives you interest on a quasi-continuous basis. There's access. There's securities. We move away from, Bitcoin, as long as you have a vast registration, you can distribute it. But if you have a vast registration, you can't distribute securitized products. So there's a distribution angle to that conversation. And I think there's a last one, which is we've still evolved in an ecosystem where the interest rate provided by the crypto ecosystem, whether it be a CeFi or DeFi, whether it be the perp funding on new DeFi perpetual exchange that have been highly topical last year, whether it be within the DeFi ecosystem, so on and so forth. You're like, okay, why would I leave my dollars locked in for a long period of time at a rate that is vastly inferior than what I can get in the ecosystem? So I think we've struggled to find the real use case or the utility. If crypto rates were to become lower than what money market funds offer, the conversation would be vastly different. But today, it's not the case.
Okay, so you're waiting and seeing kind of how things develop.
I think it will have its utility. It will grow. But here, it's not a traditional ecosystem that's going to adopt money market funds on chain. They already have money market funds. It works. What's the problem? It's the crypto ecosystem that needs to find utility for those tokens, and I don't think it's there yet.
Mm-hmm. So if there was more utility in some of these tokenized products, if there was better distribution, perhaps better rails for KYC and some of those things that are kind of a sticky topic around securities in token form, those things could be things that would accelerate adoption.
Well, I think regulation would be one. I said to distribute securities, you need a securities license. You know that very well.
For sure.
At RULEMATCH. So that's already a constraint. So the point of access are already limited. Then the velocity of the interest payout in most money market funds is not good enough because it still relies on the old money market funds rails. So if you have money to park for a couple of hours, it doesn't fit the bill. But in the crypto ecosystem, we'll look for opportunities for a couple of hours. That's fine. That's part of the benefit of the system. So I think the product is not where it should be. It's progressing and regulation will help. But today I don't see it. I don't see it there.
And just looking to the future for B2C2 in particular, anything that you're keeping an eye on that's interesting? There's been a lot of M&A in crypto recently. Is B2C2 shopping for some new ideas or things?
I think you have to stay dynamic in this ecosystem, in this line of work. So, of course, we keep our eyes and ears wide open. And as to direction of travel, even I think we've had quite a uniform path for exchange, for example, which I consider to be the representation of the retail ecosystem of crypto. We've got tokenized stocks that came out. I think this is quite a sizable change because it means anyone who was trading crypto can now access stocks as well, same portfolio. I am pretty sure they will soon be able to get the benefits of tokenized assets, notably a compoundable utility. They'll also be able to deposit NVIDIA tokenized stocks into a DeFi pool to borrow dollars to do something else, which is what TradFi is doing, right? You take your equities, you repo them, or you leave them as collateral, and you trade more, but that's not accessible to the retail world. All of this is opening, so we're keeping an eye on this. Or more than an eye. There is, of course, topics such as prediction market that you cannot ignore for multiple reasons. Why? For the growth of the, I don't know if it's an asset class.
Of the space.
I do think there's argument for and against, by the way, but it still relies a lot on blockchain rails, again, for settlements, for movement of value. So there's a whole chain. If I look at the retail world and I use the exchange as proxies, there is a horizontalization of products that are being distributed. We were very focused for a long time on the entire vertical of the product. I'm going to trade Bitcoin, I can store it, I can get leverage, I can get derivatives, I can get this and that, and now we're going a bit horizontal by distributing new assets, new topics. Because we talk about stocks because they're the biggest, but commodities are showing up. We obviously have a lot of tokens on gold, which have suddenly become far more
very
relevant.
interesting. Yeah.
I think as we speak, it's yet again making new records. So I do think we are seeing what we are seeing is the retail space is going to embrace all financial assets on chain, but just because they will have access to it, and new benefits. Equities on chain for traditional asset managers.
Not so interesting.
It'll be a bit slower.
Yeah.
But it is happening. So I think, as you said, there is what the institutional side is doing, which will have enormous size, or hopefully enormous size, but will take a lot of time. And there's the velocity of adoption of all the on-chain products on the other side, the native ecosystem. And of course, you add to that development of DeFi, which we haven't talked too much about. But then when you look at the numbers, they've been consistently growing, and will continue to do so. So I think we'll keep very
and perhaps keeping a closer eye on what retail wants in order to help to serve that in whatever capacity.
Correct.
Going forward. Just a last question. I would be interested in your take. I mean, the first, say, 10 years of crypto have belonged to retail investors for the most part. If you had to fill in the blank of crypto belongs to who in the next 5 years, 10 years, or maybe the next 2 years?
In the next 2 years, I think it stays. We'll see the growth of institutions, but we won't see the full size of institutions. I think institutions will take a lot more time. Again, because you need a lot. If you imagine how TradFi world works for traditional assets to be actively traded by asset managers, hedge funds, so on and so forth, you needed the prime broker space to the top banks to be able to provide the service at scale to all those participants. And then only the number of participants exploded. And I think it'll be the same for us here. I do think we're not there yet in terms of providing the infrastructure so that any financial participants can come. If you take the banks, and you take, let's say Morgan Stanley, for example, they've done an ETF, or they want to do an ETF. Sorry, right. They filed for an ETF. And they allow high net worth individual through E-Trade to access the product. It's a fairly small part of what they do, not to say a minuscule part of what they do. So I think we have a long journey before it's widely distributed. If you talk, I say that because you say 2 years. If we say 50 years to make it long, the only way it's not dominated by financial institutions is if and only if retail participants have taken control, full control.
Taken over Wall Street.
And they don't need a pension fund, and they don't need an asset manager.
Maybe it isn't going to happen overnight, for sure. Thomas Restout, thank you very much for joining RULEMATCH Spot On. It's been very interesting to chat, and look forward to future conversations down the road.
My pleasure. Thank you very much for having me. I have to say, much more comfortable than last year when it was minus 15 degrees.
Right. In the snow in St. Moritz.
Which made it absolutely memorable. And I hope this conversation will be as memorable.
Likewise.